Select strategy was very active in 2020, probably more active than any year that I can think of. It was a combination of some very tumultuous equity markets themselves, as well as big stock price movements in various groups, both positive and negative. And so we tried to take advantage of a number of dislocations as well as emerging new opportunities in various industries and sectors. And that was also pretty broad in terms of the asset classes that we used to take advantage of that. So while we were participating in a number of IPOs, we participated in some SPACs. We also had more private investments take place in 2020 in late stage venture capital deals than we had in prior years. We added 2 or 3 convertible bonds to the portfolio, and we were more active than usual in options and derivatives. In Q4 alone, I think we had a dozen plus new option positions added to the portfolio. So companies like Shopify, DocuSign, Wix, Livongo, Teladoc, Carvana, Mercado Libre. These were companies that we invested in many years ago that were multi-year appreciating investments in the Select strategy. But during the COVID environment, we really saw acceleration of business trends and a reflating of the multiples for those companies and appreciation for the addressable markets and future year growth of those businesses. So sort of your classic evolving opportunities that we typically invest in the Select strategy, but those are normally businesses, we don't normally see that many of businesses unearth themselves in a period of time unless there's some cyclical calamity, and that's what we experienced. So we started to rotate and have a much broader balance in the portfolio between those disruptors, those rapid growing companies, and those evolving opportunity companies that have faced some cyclical pressures that are starting to ease as we get a reopening of the economy. We had very strong performance heading into the election, and it was capping off the prior 3 quarters of strong performance where we outperformed in each of the first quarter, second quarter, and third quarter. And most of that was driven again by those disruptive, rapid growing companies that we've owned in the portfolio for many years that, again, had very strong trends underway pre-COVID, and then during COVID, a lot of those trends just accelerated. The categories that outperformed in Q4 that didn't perform as well in the first half of the year were some of those companies that faced those headwinds and pressures in their business. So specifically, they started to kind of kick into high gear in Q4. And most of those exposures were in the consumer space, industrial, and financial. So in the consumer space, companies that we significantly added to or initiated earlier in the year, like a Pinterest, Expedia, Uber, Performance Food Groups, and Crocs. In the industrial space, XPO, Regal Beloit, and WillScot. And in financials, American Equity Life, First Republic, and Truist were all positions that we initiated or significantly built up in the late spring, early summertime period and had very strong performance in Q4. In regard to what we're keeping an eye on in 2021 is first the dissemination of the vaccine in cases and how that's progressing, and the eventual impact to consumer and enterprise behavior. The other area that we're watching is valuations. The valuation rubber band has continued to stretch, particularly in more rapid growing, disruptive areas where we're still trying to figure out really how big of a market opportunity or who has real moats around their business and intellectual property that's going to allow them to really conquer that market opportunity. And some of those companies have been in the SPAC space of these newly public companies. It's companies that are growing at very high rates. We've seen the multiples on those companies double, triple, or quadruple in some cases. And so we're paying more attention and more worried about where valuations are today versus where they were in 2020 for much of 2020.